You've seen it 100 times on your screen. $49.99 to buy, $50.01 to sell. Just 2 pennies. It looks like market noise, the fine print. But that tiny, almost invisible gap is one of the most honest signals in finance. It's a real-time fear gauge, hiding in plain sight. And in a crisis, it can tell you something is wrong long before the headlines do. Every stock quote has two sides. The highest price any buyer in the market is publicly willing to pay is the bid. The lowest price any seller is publicly willing to accept is the ask, sometimes called the offer. The space between them is the bid-ask spread. In the United States, a system stitches together the best bid and best ask from all major exchanges into a single feed. It's called the National Best Bid and Offer, or NBBO. In calm markets, for a popular stock, that gap is just a penny. When fear arrives, that penny gap can rip open to $1 or more in the blink of an eye. So where do these bids and asks come from? They aren't set by an all-knowing machine, they are posted by people and firms. Some are regular investors who place limit orders, an instruction to buy or sell only at a specific price or better. But the backbone of liquidity comes from professional market makers. These are firms, often high-frequency traders, who are obligated or incentivized to post quotes on both sides of the market simultaneously. They are the ones standing by, ready to take the other side of your trade instantly. Together, all these orders create the limit order book, and the best prices at the top are what you see as the quote. If you want to trade right now, someone has to be there to trade with you. Market makers provide that service of immediacy. The spread is their compensation. It's a tiny toll they collect for standing in the middle. Part of that toll covers the obvious costs, fancy computers, fast connections, smart people. But most of it is hazard pay for taking on serious risks. They stand in front of a moving train for a living, and they demand to be paid for it. There are two main risks that keep them up at night, and these are the two forces that make spreads widen and shrink. The first and most important risk is adverse selection. This is the constant fear that the person selling to you or buying from you knows something you don't. Imagine you're quoting a stock, and suddenly a huge wave of sell orders hits your bid. Your first thought isn't, "Great, more business." It's, "What do they know? Is there a disaster brewing that hasn't hit the news yet?" If you buy from them, and 5 minutes later the company announces terrible earnings, you've been had. You were adversely selected. To compensate for this constant information risk, market makers build a buffer into their prices. That buffer is the spread. The second risk is inventory risk. When a market maker buys from a seller, they don't just make the stock disappear, they now own it. It sits on their books as inventory, just like in a retail store. If the price of that stock falls before they can sell it to a buyer, they lose money. In a fast-falling market, a market maker is forced to buy and buy and buy from panicked sellers. They are catching a falling knife. Their inventory swells with a stock that is losing value by the second. To protect themselves, when markets get volatile, they widen the spread. It's their way of saying, if you force me to hold this risky thing, the price for me to take it off your hands just went way up. So adverse selection and inventory risk both get dramatically worse when there's uncertainty. When prices are jumping around, the odds of trading against someone with better information go up. The odds of your inventory losing value go up. So liquidity providers react instantly. They widen their quotes to get paid more for the risk, or they pull back their quotes altogether to avoid getting run over. This isn't a slow, deliberate decision. It's a survival reflex, hard-coded into their algorithms. More volatility means wider spreads. It's the market's iron law. You can see this pattern play out every single day. Spreads are typically widest right at the market open. Why? Because a whole night's worth of news, rumors, and global events has built up. Price discovery is intense. Spreads are wide to compensate for that uncertainty. Then, as the day wears on and the market finds its footing, spreads narrow. Midday is usually the calmest and cheapest time to trade. As the closing bell approaches, spreads begin to widen again. Volume picks up, and market makers face the risk of holding positions overnight, unsure of what news tomorrow morning will bring. This daily ebb and flow is the spread breathing in and out with the rhythm of uncertainty. This whole process was supercharged by technology. Before the 2000s, market making was a more human-centric business. Today, it's dominated by high-frequency trading firms. Their automated systems can process information and update quotes millions of times a second. In calm, normal markets, this is fantastic. Their speed and efficiency in managing inventory risk allows them to compete ferociously, which has crushed spreads down to the absolute minimum, that single penny, on many stocks. But there's a catch. These algorithms are built on statistical models of how markets should behave. When something truly wild and unexpected happens, something outside their models, they are programmed to do one thing: get out of the way, instantly. This is why liquidity can now feel deep and cheap one moment and completely vanish the next. To understand how radical the one-penny spread is, you have to remember the old days. Before 2001, U.S. stocks didn't trade in pennies. They traded in fractions of a dollar, most commonly in eighths. The smallest possible price change, the tick size, was 12.5 cents. This meant the minimum possible spread was 12.5 cents. On the floor of the New York Stock Exchange, a human specialist managed the order book for a stock, and that wide spread was their bread and butter. Then came decimalization. The switch to a 1-cent tick size was a revolution. Overnight, competition from new electronic players could squeeze that spread from over a dime down to a single penny on liquid stocks. It transformed the economics of trading and accelerated the takeover of the machines. But a tight spread can be an illusion. That one-penny gap might only be good for the first 100 shares. This is the difference between a tight spread and deep liquidity. Think of the market as an iceberg. The price you see on the screen, the NBBO, is just the tiny tip of the iceberg visible above the water. For a small trade, it's all that matters. But if you want to sell 10,000 shares, you'll quickly exhaust the buyers at the best price. Your order will have to dig deeper, finding buyers at lower and lower prices. The full cost of your trade isn't the 1-cent spread at the top. It's the average price you get across the entire order. In a panic, that visible tip shrinks to almost nothing, and the real liquidity is much deeper and much more expensive to find. This brings us to May 6, 2010, the flash crash. In a matter of minutes, a wave of automated selling triggered a feedback loop. As prices fell, the high-frequency market makers, whose models were breaking, did exactly what they were programmed to do. They pulled their quotes. The bids vanished. Spreads on some of the world's biggest companies and ETFs blew out from pennies to dollars. Some stocks traded for a penny, others for $100,000. The iceberg didn't just shrink. The visible part melted away, revealing nothing but air beneath. It was a terrifying look at the mechanics of modern, automated liquidity. The event forced regulators to introduce new guardrails, like the limit up, limit down bands that halt trading in a stock if its price moves too violently. Now, fast forward to March 2020. The COVID shock rippled across all markets. Unsurprisingly, stock spreads blew out, on average doubling or tripling from 2019 levels. But the most interesting story was in exchange-traded funds, or ETFs, especially those that hold corporate bonds. Trading in the actual physical bonds seized up. It was nearly impossible to get a good price. But the bond ETFs kept trading on the stock exchange. How? The key is the creation and redemption process. Large players called authorized participants had to guess what the underlying bonds were worth. Their uncertainty and risk showed up directly in the ETF's bid-ask spread, which became enormous. The ETF also began trading at a steep discount to its supposed net asset value. That ETF spread wasn't broken. It was a distress signal, a real-time price for liquidity in a market that had otherwise gone dark. So let's make this real. Imagine you want to buy $10,000 worth of a $100 stock. On a calm day, the spread is 1 cent. The cost to cross that spread is about half a basis point. Your hidden transaction cost is about 50 cents. Trivial. Now it's a volatile day. The spread widens to 50 cents. The cost to cross that spread is now 25 basis points. Your hidden transaction cost on the same trade is now $25. That's 50 times higher. It's the same company, the same stock, but the price of immediacy, the price of being able to trade right now, has skyrocketed. And this happens precisely when your own fear is telling you that you need to trade most urgently. This is the pattern over and over. Calm and complacency breed tight, mechanical spreads, often sitting at the 1 cent floor set by the rules. Fear and uncertainty cause risk to take over, and the spread widens to whatever level compensates for the danger of making a market. We see a miniature version every morning at the open, and a full-blown stress test during every market crisis. And as we saw with bond ETFs, the spread can sometimes be the only honest price you can find. The bid-ask spread isn't just transactional friction. It's the market's heartbeat, recorded in real time. When it's slow and steady, things are calm. When it races, it's telling you that the cost of certainty just went up for everyone. Price is what a stock is worth. The spread is what it costs to find out right now. No predictions, just mechanics. If you appreciate sharp, clear breakdowns of how markets really work, subscribe to Tickerlore. We stick to the plumbing, not the promises.